Our featured guest this morning is Joseph Parnes. He is the president and money manager at Technomart Investment Advisors. He's also editor of the Shortex newsletter. He says 15% of your portfolio should be used to short stocks. We're going to talk about that later on. And let's just get a quick comments on these markets from our featured guest, Joseph Parnes. Joseph, we wanted to get your reaction to the data that came out this morning, the jobs data. The number came in stronger than expected. How do you think that's going to impact these markets in the short term?
Well, you can see it from the short-term point of view that the market is going to fall off because of the expectancy of the Federal Reserve probably would raise interest rates. I guess especially the index, the inflationary index part, which came out the cost 0.4% rather than expected 0.3. So you're probably going to have this kind of a short-term attitude, which we just indicated that the bonds also will fall off. But my guess is that eventually, once this settles back up, the market probably gets its momentum to go up.
All right. Well, let's go and get a check actually on these markets right now. The benchmark indices are all lower. The Dow Jones Industrials is down 27 points. The S&P is down about 6.5 points right now. The Nasdaq is also off just almost 10 points so far this morning. Joseph, you've heard everything the traders were saying. You've certainly seen the numbers today. You gave us our comments on them. Overall, where do you think these equity markets are going, given this better than expected labor picture that we've got?
Isn't this kind of ironic that here that the Fed, or at least the economy as a whole, was expecting to see some sort of employment coming in, whether it will show that the economy probably will go forward, perhaps better than 3.5% on a GDP. Yet when we see the numbers, we sort of question the market. I see that the oil price increases have done a lot of job for the Feds. The Feds has taken that to be like a deterrent in order to raise interest rates. Right now, the Fed is saying that the economy probably is progressing between 3.5 to 3.4. I doubt seriously if they're going to change their measured pace as yet. They probably will increase interest rates till it reaches, the federal fund reaches rather 4%. And then when it becomes to 4%, I think that would be a question mark.
Well, as they continue to raise rates, though, is that continue to be a headwind for the equity markets? Is it going to be harder for these equity markets to register positive gains?
Short term, you will see probably some lags, but I think the equity market has really been acting so well in the past 2-3 months. It has already discounted all the numbers that we are seeing. It has already discounted the increase in the price of the oil. It has already discounted the increase in the interest rates because the market is seeing it. That possibility exists that the Federal Reserve does not want to topple the markets by increasing interest rate much faster than the measure that they have in mind. I think that the equity market probably will take a breather a little bit over here, and you will see that probably movement will be behind it to go much higher.
But why? What's going to be the catalyst that's going to take this market higher?
I see that the institutions and the hedge funds are the really big player in the market as a whole in order to perform the accounts and the holding that they have for their clients. They have been going to the commodity and into the various derivatives available or availability of the assets to make money. Many of them have already reached topping. The oil prices has already getting closer to the top, or even if it goes any potential to the $70, still is not much room for them to make money. The same thing has been happening in the currency. The currencies actually has backfired on them, and also the bonds have backfired on them. It's very possible, in my judgment, that the hedge funds and the institutions are probably unloading some of the money from that area, and they bring it back into the equities. Plus, there is an enormous amount of the cash available in the marketplace amongst the, again, institution and others. That money will go back again into the equities. With the earnings being robust in the companies coming in for the future quarters, that gives another vehicle for them to put the money into the equity.
Do you think that what we've seen in the bond market over the last month with the sell-off that we've seen, is that a shift in asset allocation? Because we've seen the bonds going down, but we haven't necessarily seen stocks going markedly higher.
That's correct. Normally, the bonds are, at least in the past historical point of view, when the bonds fall off, the markets will also fall off as well. But really, the fall-off is really resilience into the equities. We have seen that right now, for example, the composite, major indexes, Nasdaq Composite and also S&P and also 600 and Russell 2000, many of these are making a new four-year recovery high. Those are indicative that there is power coming into it. We are in a different paradigm right now that many analysts, many interest-sensitive followers do not see. When you see that the yield curve coming down, yet the market is going up, that shows you that there is a completely change attitude in the marketplace with regard to the investors. I wouldn't be surprised to see that even this sell-off that we see right now is temporary and eventually will be shifted, the money will be shifted back into the equity.
What are some of the sectors you think people should have in their portfolios?
I think normally when the market turns around, historically speaking, technology is the one that is the forefront. The leadership is always in the technology and financials to be followed, and some consumer staples, even though some of them are being hit hard right now. Definitely in the technology you want to be one, and also medical instrumentations and drugs, because those are a must for the usage by the many, especially the yuppies that we have today in the marketplace.
Good morning, welcome. If you're just joining us, I'm Susie Assad. You're watching Bloomberg's Open Exchange, and our featured guest today is Joseph Parnes. He's the president of Technomart Investment Advisors.
And I wanted to talk to our guest about this whole short interest phenomenon. Joseph, I know that part of your strategy involves holding a significant amount of your portfolio in short interest. And just wanted to ask why that strategy, and why do you think it's not a more widespread strategy?
Very, very good question. Just to sort of express something, the numbers of the shares that you've shown before, like Calpine and KKD and others, and also Superior, we have been short on those. I just wanted to make you known. And normally we try to stay short in something on that category a long term, not just the short terms. But short interest is very important because that gives you a ratio to know whether how many people, or at least how many positions are there for shorts. And sometimes it may backfire on you, even though that it may be a high number, may not be the indicative to go short further. So what you just indicated is very important. Again, in our calculations and on the technical know-how, we really put the numbers of the shorts available, or at least short position as totality, as one of the factors either to go short or continue short or possibly cover the position.
But Joseph, as Julie was mentioning, why do you think that this strategy is not more in use?
Most people do not advertise the short selling as a tool of really making money. The analysts, the traders, others feel more comfortable to go long position than they go short positions because of a tremendous turnaround in the shorts, and that we have never really entertained or possibly educated the average public or average traders over staying shorts. As soon as there is a pickup in the positions, for example 1% or 2%, they cover the positions and of course they run away. And one thing also that really agonizes many short sellers is being squeezed, because you have to get a borrowed share, and many times the firm or the houses that gives you the shares to sell short may realize in these high numbers of the short positions outstanding, they may select to force you to buy the positions. That backfires, and that's the reason why we're really not advertising it.
And obviously greater risk associated with it rather than just buying a stock and holding on.
That's correct. If you take, for example, $10,000 worth that you buy long positions, the most you can lose is $10,000. In the short positions, however, if it turns around or being acquired, the number of the $10,000 may be much higher. That's why it's important to go with a stop loss so that you will limit the losses that you may gain if there is a backfire.
You have to be very disciplined.
Exactly.
Some of the stocks that you have chosen as good short positions here, Avid Technology is one of them. AVID is the ticker symbol. This is a stock that is already down 35% year to date.
Right.
You think it's going to go down even more than that?
Yes, we think so, because don't forget, in order to short the stocks, not only you have to have some sort of a malice report or possibly there's some problems fundamentally on the stock, but also you want to see technical positions of the stock and the action of the stock, technically speaking. And Avid is one of them. It trades below 200 days moving averages, and normally it sort of oscillates between that with a very high volume. That's indicative that the distribution is intact. And then when it rebounds, sort of a resistance lines comes ahead, and those who were not sure or that had positions long and they were losing money, they probably will go into the market again and to sell that stock down. And we feel because they're earning problems ahead, probably will be going much lower.
DreamWorks is another one. DreamWorks Animation, DWA is their ticker symbol. Again, another stock that you think is a good short bet. And again, one that's down almost 40% year to date. So already we've seen a big move down.
That's exactly right. I see distribution again on that particular stock, especially since SEC is trying to investigate. Sometimes they may not be very much, but again, all of the energy and the cost of the company will be going into the defending itself, or at least to have some sort of a form of adjustable to outline its positions to the SEC, and I think that's dreadful. Plus, their DVDs market has not done very well on the Shrek 2, and I think that will be continuous. and it's very hard to tell where this kind of a decline will stop, either 1 quarter or 2 quarters. For that reason, I think any rebound in that particular stocks would be met with more short selling again. Exactly.
All right, we're going to have a lot more with Joseph Parnes after this. Please stay with us.
My question for, I guess, Joseph would be, do you think it's too early for Microsoft, or should people be jumping on board now?
I don't think so. I didn't quite catch the questions very much, but I think generally speaking, Microsoft is an anchor in our portfolios. I really believe a company that generates close to $3 billion every quarter. It demands more to be held. Definitely it has been a laggard. I wouldn't be surprised to see that the reason for its upturn right now, not only what you just indicated, that possibility of the dividend increases, but also possibility that the shorts, the big houses who have short position on it, and program selling is important on those, probably is based on a quarter on the rise of the stock as a whole. They may be instrumental for the stock that is being turning back and is going up.
Joseph, what about overall technology? You think that there can be no real market rally without technology being the leader. However, some people have questioned that, saying that a lot of technology is no longer the amazing growth industry that it was, that you've had a lot of technology that's now being moved on to really being mature companies.
Some may have been. That is not correct in my judgment, because basically speaking, technology is the forefront of the growth-oriented kind of the companies that really develops and sort of runs the machinery of any economy as a whole. We can see it, for example, in cell systems. Cells. Without technology, you won't have the cells to be brought up to the price that you can carry in your pocket. And now it's becoming global. Globally speaking, everywhere is using it. Definitely technology is a forefront. Looking back into the history since 1948, when the advent of the semiconductor became a reality, every market turns that we have had on the bullish side has always been led with the technologies. And of course, the type of the technologies that differentiates between the era that you were there and also the era that you are right now. Could be, maybe it may have been gadgets like we had before, maybe something else coming up. But definitely, I really do believe without technology's advancement, the market will not go anywhere.
Who are the stocks that will lead this advance?
I think you will find them in the first of the all would be probably in semiconductor, because these are not only they are cyclical in some natures, but the type of the cycle that they are is a little bit different than they were before. I would say that definitely the likes of the advanced micro devices or possibly Intel, they will be the leadership in that, and also some of the memories in that category. And I wouldn't be surprised Microsoft is coming up is also in the technology as a whole. Internet right now is the most important one, and you're already seeing the leadership into the internet, into the Googles and the Yahoos and the eBay.
What do you think of the Googles and the eBays?
Well, I think the Googles, of course, don't forget, the stocks are always a hype. And of course, expectancy of the earnings growth, that's a very important thing in the technology. When you see a company is earning in the neighborhood of the 30% and 40%, double digits in years to come or quarters to come, that brings in followers and definitely accumulations in intact.
Would you short Google?
No. And you never short the stocks that are going up. You intend to short the stocks that are going down, because those kind of short selling will really trap you, because most of the drop that you see in the likes of the Google are nothing but the corrections. And those corrections are deviating percentage-wise depending on the movement of the stock.
All right. We take a quick break, everybody. Stay with us. We're going to be right back talking about Warren Buffett next.
So with that preview, Joseph, I'd like to ask you a question. I understand that you own the Berkshire shares. They've been down. What do you think it's going to take to turn those shares around?
As a matter of fact, I was going to ask him to see whether Buffett is going to make, not should I say a mistake, but in the part of the mid-90s, he sort of did not get anticipation into any technology stocks, especially into internet. And I was trying to ask him the same question right now, whether Hathaway is Buffett, are they in a position right now to change course a little bit, diversify a little bit from the insurance and go into the field of possibly technology?
Joseph, in terms of how you use, I mean, you own the shares, you have the shares. How do you use them in your portfolio?
Okay, we use the likes of the Berkshire as an anchor. For example, we maintain a certain percentage on the portfolio depending on the objective of the clients, to be in companies that have a stability, that they have good cash flows, and those we use as an anchor. So therefore, in case if the market drops and they are making money on, or that have positions in the growth-oriented stocks, they have something to rely on, and of course Berkshire will be one of them.
Is he missing a huge opportunity by not investing in technology?
Oh, I think so. I think somehow, somewhere, I think the world will get back to him. I think he himself admitted that he did not participate, or at least anticipate any technology upfront in the mid-90s, and especially in the internet. And I think he's doing the same thing again here, because just being in insurance and apparel, even right now he has missed anticipation of the energy in his portfolio as a whole.
Are you buying energy?
We have bought some, or very selectively right now, because right now you sort of coming into the top. At least my estimation is potential for getting higher is a little bit at the lower rate than it was before. I will not add, but if I have some energy positions, I will hold on to them.
All right. Well, we take a quick break, everybody. Stay with us. We're going to come back with some final thoughts from our guests. You're watching Open Exchange, 51 minutes past the hour.
I think that housing is going to stay strong for a while, yeah, we need to, for example, we need to increase exports. I hope that's going to be happening over the next few years. But overall, the economies continue to grow strong.
That was, of course, the White House's Ben Bernanke talking to us earlier today. Joseph, do you think housing is going to stay strong for a while?
I think so. I think as long as you have the interest rates down, and this interest rates probably will stay, I'm talking about the mortgage, is going to stay down because it's really globally speaking. You know, we should really thank China for that. They are holding a lot of the U.S. Treasury bills.
And keeping
the rates low. As long as that thing stays there, and of course also we have right now, today we had a very good numbers coming out on employment. So that means people are employed, they have more money, and they have affordability to purchase homes, and I think it's going to stay.
Now we have seen a huge run up in a lot of the housing stocks. Would you advocate buying still? Is there still more room for these guys to go up?
Oh, I think so. I think what you want to do, depending on what you really like, even those that I don't advocate, I like to buy some that they have a low PEs. What I mean, something below 10, because that's the normal kind of a PE you want to give to a cyclical type of the companies, which they probably will fall into. And for that reason, I have picked up two. One is a Leonard Corporation, LEN, and the other one is Havnonian, HOV. And I think those are probably have rooms to go. And the best thing to buy them is possibly to see some retraction. Like right now, the days like we're seeing right now, when they sell off, and then wait a little bit till you see a turnaround coming back into technical picture, so to speak. Then you will buy some more and then continue holding them.
It's been interesting because some people have said, you know, these guys have done so well. You've got a one-year total return of almost 50% for Lennar. You've got a one-year total return of over 100% for Hovnanian. And yet the PE ratios, as you mentioned, are still below 10.
Exactly. I don't think that the industry will command to bring their PEs up higher because they have that doubt. And the doubt is that probably will fall off again. But this doubt has been going on for 4 years continuously. And I think that doubt is actually a contrarian point of view, whereby it gives the lift for the stocks to go up. And there is, again, shorts are also in it, and as soon as they see the stocks going up, they run to cover their positions, and that's probably will make it to go up higher. Of course, the plus for them is they have earnings, and the earnings is the most important thing behind a company, and the housing industry has that.
And visibility to some extent as well.
And exactly that.
All right. Joseph, we thank you very much for being with us this hour.
Thank you for having me.
Our thanks to Joseph Parnes, President of Technomart Investment Advisor and editor of Shortex. Coming up next, you've got